Hi everyone, I'm the Tax Pro, and today we're going to talk about S corporations. S corporations are a really popular tax saving strategy in small businesses, and for good reason. They can be a great tool to save money. However, a lot of business owners that go in and elect S corp status do not understand the downsides and the requirements of S corporations. And what we see a lot when we have new businesses that come into us or existing businesses that have been operating and have elected S corp status because somebody recommended it, a lot of times they're not following all the requirements, and that leaves them very open to audit. It leaves them very open to a large amount of penalties and interest and a lot of overdue tax, essentially, and it creates a headache. So I want to go over S corporations. I want to talk about how they can save money in a small business environment. And then I want to talk about the downsides to S corporations, things that people overlook, the requirements to be taxed as an S corporation, and things that you're probably not aware of. So in order to understand how an S corporation actually saves you money, we need to understand how sole proprietorships and partnerships are taxed. And then also C corporations, because what an S corporation is it's a hybrid between these types of tax treatments. And that hybrid eliminates negatives from both sides. So it eliminates the FICA self-employment tax to a degree on the sole proprietorship and partnership side. And then it eliminates the double taxation of a C corporation. Okay, so it's this hybrid. And so where it saves you money, if you are a sole proprietorship or a partnership, and you are actively working in that business, you actively are working in or on it, you are experiencing a couple different types of tax. So you have federal income tax, and then you have FICA taxes, which we commonly refer to as self-employment tax, okay? And those FICA taxes are composed of Social Security and Medicare. And when you're a regular employee working for an employer, you pay in 7.65%, and then your employer matches that. So your employer also contributes 7.65% of your wages into your Social Security and Medicare accounts. When it comes to a self-employed individual, so somebody who is a sole proprietorship or a partnership, they pay that full employee portion and the full employer portion because they are both the employee and the employer. Okay, so they pay 15.3%. When you are self-employed, your self-employment tax is 15.3% of your bottom line. Okay, that's painful, right? Because that's on top of your federal income tax. So your federal income tax is a separate type of tax. 15.3% is painful. The majority of that is Social Security, and Social Security does cap at a certain point. Okay, so once you reach a certain point, which is it's a little bit below 200,000, and it's adjusted every year for inflation, so it goes up. But once you reach a certain point, you no longer have Social Security, but you still have Medicare. And then Medicare, you get an additional Medicare tax once you reach a certain income threshold. So then you get to pay even more into Medicare. What happens with an S corporation is the income of the S corporation is not subject to self-employment tax. There's no FICA tax. You only have federal income tax. So it eliminates the 15.3% of your self-employment tax on the S corporation income. Now there's a catch here that most people who come to us are not compliant with. You have to pay, if you work in or on this S corporation, you have to pay yourself reasonable compensation via W-2 payroll. And that W-2 payroll is subject to FICA taxes. So you then become an employee and you have 7.65% withheld from your paycheck, and your employer, which is the S corporation, pays in 7.65%. So you still pay 15.3% on your reasonable compensation. And the IRS knows that the point of the S corporation is to reduce that FICA tax. And the IRS knows that a lot of people either artificially understate their reasonable comp or they don't pay it at all. And it is something that the IRS is focusing more and more on in their audits. So what can potentially happen is if you're not paying reasonable compensation, the IRS can come in and restate some of your earnings into payroll. At that point in time, you've underpaid payroll taxes, your payroll tax returns are incorrect. If you filed any at all, because maybe you don't have any payroll, if you are not on payroll, so you've underpaid, you have inaccurate returns, and you're gonna get penalties and interest, right? It's gonna be painful. So that's an S corporation. That's the benefits. You get a save in FICA, but the catch is that you have to pay reasonable comp. So that's how it compares to a sole proprietorship and a partnership. Now let's talk about how it compares to a C corporation. When it comes to a C corporation is double taxed. And what that means is if we think about a company like Google pays taxes. Google pays federal income taxes on C corporation tax return. Okay, so that's one layer of taxation. And then Google will pay dividends to its shareholders. Okay, and those dividends are coming from this income that's already been taxed. And then it goes to the shareholders, and the shareholders get taxed on the dividends. So there's two layers of taxation. We call this double taxation. It is taxed at the corporate level on the corporate income tax return, and then it is taxed again at the shareholder level when they get taxed on dividends. Okay? So an S corporation does not pay income tax. The S corporation itself does not. There's very limited scenarios in which an S corporation pays tax. The S corporation actually passes through the income to its shareholders. And those shareholders are taxed on their share of the income of that S corporation. If the S corporation declares dividends, and we call them distributions within the S corp world, but they're the same concept as dividends. If an S corporation pays distributions to its shareholders, those distributions are not taxed as long as that shareholder has basis. And I'll get to what basis is here in a minute because it's another downside of S corporations and it's complicated. So that S corporation, that income is only taxed once. Okay? It's eliminated the double taxation. So it has limited the FICA tax or the self-employment tax of sole proprietorships, and it has eliminated the double taxation of C corporations. So it's a great setup, right? Now let's look at the requirements for being an S corporation, which I have pulled up here. But I'm going to talk about the downsides of S corporations because there's a lot of downsides a lot of people don't realize. So an S corporation are corporations that elect to pass corporate income, losses, deductions, all that good stuff to shareholders, right? So that's where it eliminates that double taxation. To qualify for an S corporation status, you have to be a domestic corporation, which means that you're in the US. You have only allowable shareholders. So those shareholders can be individuals, certain trusts and estates, and they cannot be partnerships, corporations, or non-resident alien shareholders because the IRS wants to keep the earnings in the tax savings in the US. Okay, so it's only going to give this tax break to individuals and then certain trusts and estates that are in the US. It can have no more than 100 shareholders. So this is not often a problem for small businesses, but it can be a problem for like kind of on the large side of small business and medium sized businesses. It can have no more than 100 shareholders. However, married couples count as one for this purpose. So you could have a husband and wife that each own stock in the S corporation, and for the 100 shareholder limit, they count as one, even though each of them individually owns stock. For this limit, they count as one shareholder. You can only have one class of stock. What this means is you cannot have like preferred stock where certain shareholders maybe receive dividends when other shareholders do not. This is different from a C corporation. Okay, you can have different classes of stock in a C corporation. Certain shareholders may receive dividends when other shareholders do not. So what this means is, and this is a downside that sometimes I see shareholders not aware of, if you have a partner that's a 40% shareholder and then you have another that's a 60%, if this 60% shareholder decides they're taking distributions of $60,000, guess what? The 40% shareholder has to receive $40,000 in distributions. They have to have distributions equal to their ownership. If one shareholder takes distributions, all the other shareholders have to have the same distribution in accordance to their percentage of ownership. Okay, you can only have one class of stock. I've seen this to where this has created some issues with shareholders where they didn't realize that was a thing, and then they got kind of mad because they weren't allowed to take distributions because the other shareholders were like, no, we're not distributing distributions. And one of the issues here as well is that if you take no money out of that S corporation and it makes a lot of money, you still have to pay tax on that income, on your share of income, even though you've pulled no money out of that S corporation. This can be extremely tricky. If you, let's say you pay in and you're a 10% shareholder in this S corporation, and that S corporation makes $100,000, or sorry, $1 million, and your 10% share is $100,000. Okay, so that S corporation made $1 million on their return. They divvy it up, and your 10% is $100,000. On your tax return, you have to recognize that $100,000 worth of income. And if no distributions were declared and you don't get any distributions, you're still liable for that tax. So if you're in the 37% tax bracket, and there's some other calculations, so this wouldn't be the exact tax amount, but you'd have to pay $37,000 in tax and you got nothing out of that business. That's the reality of an S corporation. So if you buy into an S corporation, or if you're a shareholder in an S corporation, it's really important to understand when you may be taxed and then also when you may pull money out of that corporation. Because if you're going to get taxed on income from the corporation, but you have no power to pull money out of it, you could be in a scenario that's really financially uncomfortable. Now, a solution here would be to have an ironclad operating agreement that clarifies when distributions are issued and paid out, and how that ties into the income and all of that good stuff. I've seen where arrangements are made to where the S corporation has to distribute earnings to shareholders based on the income, and it's essentially made to cover the tax that those shareholders may experience by owning part of that S corporation. It's a great thing to have in your operating agreement, especially if you are not in control of when distributions are distributed, right? You also can't be an ineligible corporation, so certain companies cannot be S corporations. So this gives you some good information that's straight on the IRS website about who can be an S corporation. So let's kind of dive into the negatives of S corporations that people just do not recognize. So one is the reasonable comp side. You have to pay reasonable compensation, and that reasonable compensation has to be paid via payroll. It has to be via a W-2. I have seen some accountants try to work around that, and that can create some other issues. And it can create some problems if the taxpayer's audited. Okay, there's not really a workaround there. You have to pay W-2 and you have to pay FICA. So you have to pay W-2 wages. The downside, another downside to that is you really should be paying a payroll company to then run that payroll. And for a lot of businesses, they're like, yeah, that's great. I already pay a payroll company. It's going to cost me a couple more dollars a month in order to put myself on payroll. Not a problem. However, if you're a really small business and you're not running payroll is costly. And I never, ever recommend doing it by hand. The reason being is because the payroll fees and penalties and interest associated with doing it incorrectly can be costly. And it can be extremely complicated, especially states where you have local taxes like Ohio. It can be really costly to not hire a payroll company. We always say outsource it to a company that's all they do is payroll, because they will often cover penalties if they make mistakes. Like at my firm, we do not offer hand running payroll because we just cannot charge enough to cover our liability there. Mistakes are bound to be made, especially in complicated states such as Ohio. So you have the added cost of running payroll. If you're not currently running payroll, you're looking at an additional like $600 a year, kind of minimum, to run payroll. And that's on top of, what your reasonable comp is. So you have to pay for a payroll company to come in and run payroll. That's a downside. An S corporation tax return looks way different than a sole proprietorship. So I'm going to show you what I mean by this. This is a Schedule C. So this is the sole proprietorship tax return form for sole proprietorships. Now, if you have a farm that's a sole proprietorship, that's a Schedule F. It looks kind of similar. It's kind of got the same concept. This is what most of you are filing, is this sole proprietorship, okay? This sole proprietorship form is short. This is the sole proprietorship form. Now, obviously, you may have some statements that support that, and that's okay. You might have some statements, but it starts at 2 pages, okay, the sole proprietorship. This is the S corporation return. So what ends up happening is, your sole proprietorship gets filed with your personal return. S corporations are a different beast. They have their own tax return, no income taxes paid unless like very, very rare scenarios. This starts at 5 pages, okay? And there's a lot of questions on here. It is extremely complicated. You also have additional schedules on here. You have your balance sheet. You have reconciliation of income per books with income per return. You have this analysis of accumulated adjustments account. These schedules are really important, because these all tie together and they run year after year after year. And it is a great way for the IRS to determine if your books are messy. And if your books are messy, your schedules will not line up with each other because all these schedules feed into the other. And then they tie into next year's return and the year after. And if these schedules don't tie together, it is a great red flag to the IRS to say, hey, there's probably stuff on this return that is incorrect. Okay? What this means for you is that you have to have solid bookkeeping. And a lot of small business owners do not have solid bookkeeping. Okay? You have to. There's information that the IRS gets that will tell them if there is an issue in your books. No more spreadsheets. You have to have a double entry accounting system that is going to give you a balance sheet. One of the things that I commonly see, if we have new clients come to us and they say, hey, we're an S corporation, here's our prior year returns that we had prepared at this other firm. Probably about 50% of the time, and that's probably being generous, honestly, probably more frequently than that, these schedules do not line up. I see this with CPAs, I see this with enrolled agents, I see this with tax attorneys. These schedules are incorrect. And they are not properly tied together, and they do not properly tie to the books. I see it all the time. One of the most common mistakes that I see is the balance sheet doesn't balance. The balance sheet is called a balance sheet because it's supposed to balance. Okay, your total assets right here on line 15 always equals your total liabilities and shareholders' equity on line 27. It has to balance. It's called a balance sheet. The number of times that I have new clients come in and say, here's my return from this prior firm, and they don't balance is wild. Okay, so it's a huge red flag. But what this tells you is that there's a lot of work that goes into this, and your books need to be accurate. If they are not, you are waving a red flag to the IRS to come audit you, okay? Because if this information is not accurate, your tax return is probably not accurate. So this return starts at 5 pages. And then for every shareholder, you get a Schedule K1. So there's an additional schedule for every single shareholder. That Schedule K1 then flows onto Schedule E of your personal return. And then it flows onto other schedules of your personal return, okay? So it's a far more complex tax return. Now, if you have a partnership and not a sole proprietorship, this return is very similar to a partnership return. Very, very similar. Same thing with partnership returns, though. The number of times that I see balance sheets not balanced and those schedules not tie out is wild, okay? So make sure that everything is balancing and tied out well, that your books are solid. So that's a downside to the S corporation. These returns to prepare cost way more than the returns of a sole proprietorship. Tax prep softwares cost more for these specific types of returns. They charge more per return. The time it takes to go in and prepare these returns properly is way more than a Schedule C. And to vet all the information, your tax prep fee is going to go way up filing a S corporation. I have seen people try to file them themselves. So a Schedule C, I don't always think that it's the best idea to file these yourself if you're in business. You're often going to overlook tax savings opportunities, right? But I've seen people who have prepared these self-prepared, and oftentimes they're okay. They're not wonderful. Maybe they left some money on the table. But it's reasonable to research how to do this and prepare your own Schedule C. I really never recommend that people prepare their own S corporations. Whenever I've seen it, it's really messy. So you end up having an increase in tax prep, okay? And compliance when it comes to bookkeeping, because if you haven't been paying a bookkeeper, you probably need to start. It's really difficult for small business owners to get their books completely clean. So that's one of the downsides to S corporations. Keep in mind that these increased costs that you're going to experience for things like tax filing and payroll, those cut into your tax savings, okay? So if your bottom line is really close to or below your reasonable compensation, there is zero reason for you to elect an S Corp status right now, okay? It is going to end up costing you more money, and it's going to save you nothing in taxes. Or very, very little, to the point that you have paid more in compliance costs than you have saved. And then it creates a giant headache, okay? I see a lot of people that go in and they don't have the income to support an S corporation election. The other issue with an S corporation election is it does limit what we call your qualified business income deduction. So S corporations, partnerships, and Schedule Cs, those are all eligible for what we call the QBID, which is the qualified business income deduction. And the QBID is taken on your personal return. So the way it works, and there's some limits that I'm not going to go into, but the QBID is roughly 20% of the income from either a sole proprietorship, a partnership, or an S corporation. Okay, so with partnerships and S corporations, if there's more than one owner, it's essentially like your share of the income. It's 20% of your share. Sole proprietorships, obviously you're the only owner, so then it's 20% of that sole proprietorship income. It's roughly 20%. With a Schedule C, you're not paying yourself payroll, right? There's no payroll deduction for your wages. So it keeps that QBID higher. Whereas with this S corporation, you deduct the compensation to your officers or to your shareholders on line 7 or 8. So you reduce the bottom line, the taxable income from this S corporation by your wages and your payroll taxes. Okay? So then your ordinary business income is lower. So your QBID is going to be lower. Your qualified business income deduction is lower. Nobody really talks about that. It does affect your QBID. Okay? Which can be a problem. It can be a downside. Your savings are going to be more if you have like a lot of income in your S corporation. Generally, your savings are more than what the reduction in your QBID like creates as a reduction. But it is a reduction, okay? And it does affect your tax savings. So that's one thing to keep in mind. That's another downside. One of the biggest downsides that we see is the inability to move assets and cash out of the S corporation. And I'm going to explain how this works. And sometimes I get like people who there's a lot of confusion around this, and that's okay. It's a very complicated concept. Let's first talk about assets getting pulled out of the S corporation, because I think that's kind of easier to understand. And then we'll go into basis and trying to get cash out. So when it comes to assets within the S corporation, the S corporation is considered completely separate from you as a shareholder. It is almost like its own little person. And if the S corporation owns an asset that maybe you want to pull out later for personal use, and I like to use the example of a home. So let's say that the S corporation owns a residential rental, okay? And that rental, it sits in that S corporation for 10 years. And now that S corporation, that rental is worth $400,000. And you just love this rental and you want to pull it out of the S corporation and you want to gift it to your child, or you want to move into it, or something along those lines. The issue with that is the S corporation is separate. So if you go to pull that asset out, it is like a sale. You have to create a sale, an arm's length transaction, when you move that property out of that S corporation. And that sale is taxable. Even if no cash comes out, if that property is worth $400,000, the S corporation has to recognize a sale of $400,000. I maybe didn't put any money into the S corporation. No cash came out of my pocket. I didn't pay the S corporation for that. It does not matter. That S corporation has to recognize $400,000 in revenue. If that property costs $300,000, the S corporation has a basis of $300,000, that's $100,000 added to the bottom line of that S corporation, and tax has to be paid on it. That's a problem, because that income flows to your personal return, and now you're paying tax because you pulled an asset out of the S corporation. So you have to be very, very careful about what assets you are putting into the S corporation. In general, real estate is not a good idea to put into an S corporation just because there's really no point. Rentals very, very rarely are subject to FICA tax anyways. So it's not something that creates any sort of tax savings or benefits to put it into an S corporation. Very, very rarely do we recommend putting like a residential property for like a residential rental into an S corporation. Not saying it doesn't happen, but in general, it's not a good idea. So you just have to be careful what assets you're putting into the S corporation because you can create tax down the road if you need to pull them out. So that's a downside to it. Now let's talk about getting cash out of the S corporation. So you're never taxed when you take distributions. Generally, as long as you have basis in the S corporation. But if you no longer have basis, you are going to be taxed when you pull cash. And let me kind of explain how basis works. I've got a little a dry erase board that I'm going to work with here. So let's talk about basis in your S corporation. In general, basis is equal to your contribution. So your contributions into the S corporation or what you paid to get into the S corp, that increases your basis. Okay? And then you have your share of income. Your share of the income increases your basis, okay? If you have a loss, though, your share of a loss for the year is going to decrease your basis, okay? And then the distributions that you take decrease your basis. So we have a couple of things that impact our basis here. Contributions and what you pay for like your share of the S corporation, that increases your basis. Your share of the income every year increases your basis. Your share of losses every year decreases your basis. And distributions decrease your basis. There's a couple of other things that impact your basis, but this is kind of in general what we're looking at. And this will get the point across here. Your basis, if you hit 0, you cannot take distributions beyond your basis. Okay, so let's kind of run through a scenario and I'll explain what I mean by that. So I'm starting this S corporation and I'm going to add $100,000 into this S corporation. So I have a contribution of $100,000. So now my basis right now lives at $100,000. Okay, that's my basis because I've contributed $100,000. There's been no activity. Now at the end of the year, my share of the income is $50,000. And this is based on the S Corporation 1120S and my K1. Okay, so my K1 that the S Corporation prepares for my tax return is going to give me this information. So I have an increase of $50,000 into my basis. My basis is now $150,000. Okay? So if I take $100,000 in distributions, that's fine. I don't get taxed on that. My remaining basis is $50,000. Okay? Let's say instead of $100,000, I took $150,000. Okay, no problem. My basis in this S corporation is now 0. That's okay. I'm not going to get taxed. Okay, I'm not going to get taxed on that because my basis is 0. I didn't take beyond my basis. I just took it down to 0. And that's okay. You can do that. There's no repercussions there. Okay? And this doesn't mean that I own 0% of this S corporation. This is just my basis. Your basis is not equal to the amount of ownership that you have. Okay? Let's say though that I'm in a pickle and I had to take $200,000 out as distributions. That means that I have pulled $50,000 beyond my basis. My basis cannot go negative. Now all of a sudden I have this $50,000 that I've taken beyond my basis. I'm actually going to have capital gains tax on this $50,000. In addition to the tax that I've paid, okay, on the income of the business. So I still have to pay tax on $50,000 because that's how much my share of the income is. So I'm still paying tax on $50,000, but I also took $50,000 beyond my base. I pay capital gains on this. Okay? So I'm going to pay capital gains on this particular $50,000. Okay? Because I can't draw money out beyond my basis. That's a problem. So let's kind of look at another scenario where I put in $100,000. Okay? So my contribution into this S corporation was $100,000 when I started it. Business lost a lot of money. A lot of money the first year. Okay, my share of the loss is $210,000. $210,000. Okay? When we look at this, now I have no basis to pull from. Okay? Because 100 less this 210 is negative 110. There's nothing that I can pull out of this business. If I pull distributions, I'm going to get capital gains tax. Okay? Which is unfortunate because I put $100,000 in. Okay? But that was my contribution. There's some different ways that you could avoid that. Like maybe you're, instead of doing a contribution, you loan money to the business. And then you could still pull money out on that loan because you are allowed to loan money to the S corporation. At that point in time, you have some different basis calculations. I'm not going to go into that because it gets pretty complicated. But that's a downside to an S corporation. I just want you to realize that you can't pull money beyond your basis out of that company without experiencing additional capital or without experiencing capital gains. So you experience additional tax. A lot of downsides to S corporations that people just don't realize. Had a lot of people surprised that they can't just pull money out of that S corporation. But that's the thing. You cannot just pull money out of the S corporation. Okay? If you have basis, you can, and you won't experience any sort of tax issues. So that's an S corporation. Lots of upsides. That 15.3% can save you a lot of money. So for example, if we have somebody that their share of the income in the S corporation is $150,000. And let me kind of show you savings here. And this is kind of how we break this down. So let's say that we know that this individual is going to make $150,000 in income for this year. So they have $150,000 and they started as a sole proprietorship, okay? They have $150,000 in income. In a sole proprietorship, they're going to have a couple of different types of tax, right? So they're going to have federal income tax, which I call FIT, and that's going to be based on their bracket. Okay, so that's based on their tax bracket. And then they're going to have FICA, and that FICA is 15.3%. So let me pause and I'm going to pull up my calculator. Okay, so I pulled up my calculator so you can see how this works. They have $150,000, okay? They have to pay 15.3% in FICA taxes. that FICA that they're paying is $22,950. So what we have here is we have $150,000 in taxable income. They have federal income tax, which is based on their tax bracket. And on top of that, they have FICA of $22,950. It's a problem, right? That's a lot of money. It's a lot of money. Now, if they go to an S corporation, they are going to split this 150. And let's say that we do a reasonable comp study. And to make things easy, the reasonable comp is $50,000. And reasonable comp varies a lot. So I have some clients that come and their savings are not that much just because their reasonable comp's a lot. So we're going to pay $50,000 in reasonable compensation. That means that they are still paying $7,650 in FICA. Okay? So what I did is I took this $50,000 in reasonable compensation, and we have $7,650 in FICA still. Okay, so they're really only going to save, they're not going to save that full 22. They're going to save $15,300. Okay, so if we have a savings in FICA of $15,300, let's kind of break down what we have as far as investments. So our savings right now is $15,300. Okay. Now we're going to go in and we have to pay for a payroll service. Maybe this sole proprietorship has not paid for payroll before. Okay. So now they're subtracting about $600 per year to run payroll. Their tax prep fee increased by about $1,200. And this is an estimate. Obviously, it's going to depend on who you're using, right? Don't go tell people that my tax prep fee should have only increased by $1,200. That's not necessarily the case, right? So their tax prep fee increased by $1,200. They also realized they can't keep their books on Excel anymore. You'd be surprised how many people do that at that income level. Please don't do that if you're at 150,000, please. So now they are paying for a bookkeeping software. And I would like to say that it's only going to cost them roughly $50 a month. Depends on the software. Obviously, this can vary. But another $600 out the door to the bookkeeping software, right? They're struggling a little bit, so maybe they need some bookkeeping help. This is when it may get a little more expensive. So they hire somebody to do their actual bookkeeping, which in all reality, if they're at 150, it probably would have been a good idea anyways. But let's say that their bookkeeping is now going to cost them roughly $600 a month. So now we're looking at $7,200 in bookkeeping. Okay. Do you see how my $15,300 is kind of benefits kind of going down a little bit? So they have experienced an additional $600 in payroll, $1,200 in tax prep, $600 for their bookkeeping software, and $7,200 for bookkeeping assistance. So total additional cost is $9,600, and this is assuming that they didn't necessarily pay for assistance getting that S corp done. Okay, $9,600. So we now have a much lower savings. So we have $15,300. So their savings are now $5,700. Okay, this is what this looks like. That's not bad. Okay, that's not a bad savings, but it's not necessarily what we would want to see, right? So S corporations alone don't necessarily save you a ton of money if you have to add a bunch of additional stuff. And then I haven't factored in the QBID deduction there. A couple of things though to keep in mind is I know like when people come to my firm and they want an S corporation election, we not only set them up with an S corporation, but we set them up with some additional savings strategies that are kind of exclusive to S corporations that you can't use in other companies. So that can add to your tax savings, which makes it a little bit more worth it. There's some different stuff that you can do in an S corporation that you can't necessarily do in a sole proprietorship. So we can add those savings there and take advantage of those items, which can increase the amount that you're saving. Okay. But you can imagine if that, let's kind of go through that scenario and let's say, so we had an additional $9,600 in costs, right? And let's say that they still do their own bookkeeping. So let's take $9,600 and we'll subtract that $7,200 in bookkeeping. Okay. So their costs for this S corporation, let's say that their cost is $2,400. Okay. Let me rewrite that. That's not super legible. So their cost is $2,400. Okay. So it cost them $2,400. We took away the bookkeeping. And let's say that their reasonable comp is actually $125,000. Okay. So if their reasonable comp, their income, was 150, which means that they were initially paying $22,950 in FICA. If their reasonable compensation is $125, they're still paying FICA tax of $19,125. Okay? So let me repeat that so you can follow along. Their cost increased by about $2,400 a year. Okay, and remember, we kind of took some costs away there, so we're assuming that they're doing their own bookkeeping, right? So their cost increased by about $2,400 a year. The FICA tax that they were paying as a sole proprietorship, making $150,000, was $22,950. They still had to pay FICA tax on their reasonable compensation, and we do a reasonable comp study, and their reasonable comp is $125,000. That means that they are still paying FICA tax of $19,125. Okay? We take this $22,950 and we subtract this $19,125. They're only saving $3,825. But we have to remember, so they have a FICA savings of $3,825. They had an increased cost of $2,400, which leaves their bottom line savings to $1,425, and that's before we get into the Cuban. They're not saving that much money, and they got a bigger headache, right? So there's a lot of times that I'll have people come into our firm, and an S corporation honestly does not save them enough money for them to deal with it. So that's something that I really don't think a lot of people talk about. I think a lot of accountants, I don't think that they purposely mislead clients. I don't think that they necessarily understand the additional compliance issues that come with S corporations, and it's kind of overlooked. But if you have somebody who is working in an S corporation or on an S corporation, they're the shareholder and their reasonable compensation is high, the savings that they will experience by electing an S corporation are not that significant sometimes. And it means that that S corporation is not a good idea. I have seen those videos on TikTok and on Facebook and Instagram and all of that says once you reach $60,000 in your Schedule C, you have to elect an S corp if you want to save money. In the scenario we just ran with $125,000 of reasonable comp, that advice would have lost that client money. It would have lost them money. Okay? Don't follow that advice. The advice that if you are an S corporation, you pay like 40% or 60% of the bottom line as reasonable compensation. That is also incorrect. It does not fit a lot of scenarios, okay? I shouldn't say never, I will not generally recommend that a client whose bottom line is $1 million pays themselves $400,000 in reasonable compensation. It does not make sense. The IRS is not looking for a percentage. They are looking for reasonable compensation that is backed up by data. Okay, and that data is not percentage based. It does not make sense. It does not make sense to pay a percentage as a reasonable compensation, and it does not make sense to have every company that is making this amount or more should be an S corporation. That is professionals doing a disservice to business owners. Don't listen to that. It's not good advice. Okay, so I'm going to get off my soapbox. And hopefully that was helpful. S corporations can be a great tool. They can also just kind of suck some money from your business, so be careful. If you have any questions, let me know. Hopefully that was helpful. If it was, I would appreciate a like and subscribe, and I will see you guys next time.